Please start. Okay, welcome to EPPE 3023. So, presentation today, balance of payments.
Okay. Hi, Assalamualaikum and good morning to everyone. So we are from group 10, want to answer the question about the topic of the balance of payment. Next, this is our group members. So I will pass it to the first presenter to answer the question number 1.
Okay, so from a functional viewpoint, a nation balance of payment can be grouped into two categories. What are these categories? Name them. What does each category refer to and include? Next. Okay, the first category is current account transaction, which is referred to the monetary value of international transaction of goods, services, incomes, flows, and transfer. The second one is capital and financial account transaction, which is referred to all international purchases or sale of assets, which include corporate stocks and bonds, government securities, ordinary commercial bank deposit, and title to real estate. Next, I will pass to the next presenter.
Question 2. Indicate whether each of the following items represents a debit or a credit on the nation BOPs. First, a nation importer purchases a shipload of Thai rice, recorded as debit. A Korean automobile firm builds assembly plant in Malaysia, recorded as credit. A British manufacturer export machinery to Taiwan on a Malaysian vessel, recorded as credit. A Malaysian student spent a year studying in France, recorded as debit. Nation NGOs donate food to people in Darfur, Africa, recorded as debit. Japanese investors collect interest income on their holding out of nation government securities, recorded as debit. A Korean resident sent money to her relative in Malaysia, recorded as credit. Toyo Marines of Japan sells an insurance policy to a Malaysian business firm, recorded as debit. A Singapore resident received dividend on her Malayan banking Berhad stock, recorded as debit.
This is the table of international transaction of the United States. Next. A. Calculate the U.S. merchandise trade, services, goods and services, income, unilateral transfers, and current account balance. Next. So merchandise trade balance is export minus import. $375 billion minus $450 billion equal to negative $75 billion, which is deficit. Next. Services trade balance, travel and transportation receipts net plus other services net, $25 billion plus $35 billion equal to $60 billion, which is a plus. Next. Good and services balance, negative $75 billion plus $60 billion equal to negative $15 billion, which is deficit. Next. Income balance, receipt on U.S. investment abroad minus payment on foreign investment in income balance, $20 billion minus $10 billion minus $5 billion equal to $5 billion, which is a plus. Next. And unilateral transfer balance equal to negative $20 billion, which is deficit. Total current account balance, goods and services balance plus income balance plus unilateral transfer balance, negative $15 billion plus $5 billion minus $20 billion equal to negative $30 billion. Next. Okay, which of those balance pertain to net foreign investment position of the United States? How could you describe that positions? Next. Current account deficit impacts the net FDI position of the US has a deficit. It will be the net demander of funds from the world. So I'll pass to the net presenter.
Oh, we cannot hear you. You gotta unmute your mic. Please, someone alert him. Call him to unmute.
Wait, Doctor, sorry. So sorry, guys. Do you hear me?
Yes. Yes.
Oh, okay, sorry. So I can start with my part. My computer didn't start. So coming up to the question, it was what the positions of the United States was and how they are invested. So first of all, we have to determine the net international investment position of the United States, and for this we have these 4 signs given. And the next page, maybe you can change. Yes, we have first of all the debits of the United States. Therefore, we add the foreign official assets in the United States and the other foreign assets, and we have a total of $250. And in the next page, we have the credits, where we just add the credits, which is the U.S. government assets abroad and the U.S. private assets, and it's a total of $225. And if we just take these 2 totals, we had this credits minus the debits, which is minus $25, and it shows that the debits are bigger than the credits and that the U.S. nation is a net debtor nation. Okay, thank you, Bukit. So the question number 5 is the international investment position of a nation is measured by the balance of indebtedness. Briefly explain that the balance of payments is a flow concept, whereas the balance on international indebtedness is a stock concept. Next. So the balance of payment is a flow concept, as is it measured over during the period of time. Since BOP is measured over a time interval, it can be said that they have an element of time attached to them. The BOP records all the monetary transactions made between residents of a country and the rest of the world during any given period. When all the elements are correctly included in the BOP, it should sum up to 0 in a perfect scenario. This means the inflows and outflows of funds should balance out. Next. So the balance of international indebtedness is a stock concept, as it summarizes fixed stock of assets and liabilities against rest of the world that measure of a particular point in time. The balance of international indebtedness is equal to the stock of foreign asset owned by domestic resident minus the stock of domestic asset owned by resident abroad. A positive balance of indebtedness means that the country is a net international creditor, and a negative balance means that it is a net debtor.
Okay.
Yes.
Thank you. Can you summarize? One of your group member summarize the main points, or maybe one or two main points from these questions. What am I trying to get at? Okay, go ahead. One of your member. Okay, please. Please, anyone from the group? At least one point that I want to get the message across. Hello? Waiting, counting 1, 2, 3. Yes, go ahead. Let me call who? Yaya? Yaya Saini. Or who? Who is in the group? And from the floor also, please prepare one question for them. So please, time. And this is being recorded for you to study, to review. And please, I'm calling on one of your member in the team, a member in the team to...
Maybe I can just say something. The question was what the balance of payment is, or what was the question?
The question is, what is the main message I'm trying to get at with all the questions that I've chosen?
Yeah, maybe that the country has to take care of its balance of payments for the economic transactions.
Okay. Yeah, that's true too. What are other...
And maybe when it's recorded, maybe annually or quarterly, and yes.
Well, that's not the main...
What do you want to hear?
The main point is that there's a double entry. That's number one. Debit and credit. What you get is credit. What you pay outside of the border to other national is debit. So those debit and credit will ensure, double entry will ensure balance when we do accounting. Balance will come from one side, either debit or credit, one of those account will become positive or negative, but the whole thing will be balanced. That's double accounting concept. Number two, there are two parts in the balance of payment, the most important parts, which is current account and capital account. So this will show that country, you know, deficit in current account, it shows that that country is a demander of a fund from outside. You know, and that's another thing. There's international position, investment position, and all those that you must really understand. But the most important is the current account. I think that's my message all along. That current account, within that current account is the trade account. Because we have trade account, merchandise and services, trade account of both merchandise and services, and we have the income account, we have the transfer account. Those are not really that important, but the most important is the trade account. So whether you will have surplus or deficit in current account depends so much on the trade account, international trade. Yeah, I think that's my message. Thank you for the group. Okay, we take a break for 5 minutes. I'm trying to. Okay, we take a break. Thank you all. Oh yes, one question from the group, from the floor. Okay, I forgot. Okay, one, please. For the group. Please. One question from the floor to the group. Please, let me reiterate what I said just now. If there is a surplus, what happens if there is surplus in current account? That country becomes a supplier of funds to the rest of the world, a supplier. If that country has a current account deficit, that country is a demander, net demander of funds from the rest of the world. Whereas the international investment position, it is taken at a particular time. It's a stock concept, whereas balance of payment is a flow concept, because you take the whole year flow concept, the flow of 1 year, within 1 year. That's balance of payment is a flow concept, whereas international investment position is a stock concept, because you take at particular time, say 31st December of particular year. So it is measured by the balance of international indebtedness. International investment position of a country is measured by the international indebtedness. Okay. So I'm still waiting for the question. One question from the floor to the group, please. Go ahead. Hello, please.
I want to ask.
Yes. Your name, please?
My name is Aida Yasmin.
All right. Go ahead.
Why would it be useful to examine a country's balance of payments data? Thank you.
Yeah.
I think it will be useful to examine country BOP for at least two reasons. First, BOP provide detailed information about the supply and demands of the country currency. Second is BOP data can be used to evaluate the performance of the country in international economic competition. For example, if a country is experiencing a potential BOP deficit, it may signal that the country industry lack competitiveness. That's all. Thank you.
Let me answer differently. Balance of payments is the big one. Within the balance of payment is the current account and the capital accounts. These are the two main things that you really must focus on: current account and the capital account. Capital account, okay, the second one. Capital account is analogous. Analogous to means that similar to. It means that what is similar? Similar, this is same. Oh, if you can see. Oh. Same, okay? Same. Silver and black on the top. Same, exactly the same. This is similar. Almost the same. I'm teaching you English. Same size, but not quite the same. This one has got the yellow color. This one silver and black. Similar. So analogous. Which the capital account is analogous to export and imports. Because what you export and what you import, you must be balanced that out with capital account. Meaning that if you have deficit, how do you pay your deficit? Either people investing, you got the money, or you borrow, loan. So those are, in the capital account. What you do in the trade account, which is, current account. Let me repeat. Current account has three parts: trade account, income account. Income is not transaction, just something. What is transaction? Don't get confused with bank transaction. That's bank transaction. We're talking about a transaction in economics, international trade study. When there is selling, you don't sell, no transaction. For example, I transfer money to another country. That's not transaction. Even though bank, yes, transaction, you transfer money. But for in trade theory, no, that's not transaction. Transfer, just transfer, send. No selling, right? So in trade theory, trade studies, when there's only selling and buying, sell and buy, that's transaction. No sell, no buy, no selling, no buying, no transaction. So transfer is not a transaction. Income is not a transaction. Just somebody pay me or I pay. So first part of current account is trade account, goods and services. Second part is income. Third part is transfer. And of course, there's a transfer. Omission is all the way down for the balance of payment. So current account. The most important part of current account is trade account. Okay? Not all this transfer, because not many countries will do a lot of transfer unless a very developing and poor country, which depends on repatriation of money from workers. The citizen of that country go overseas all over the world to work in whatever. For that country, transfer is a big part. then become a major thing. That country has many people working as maid outside our country, construction worker. I mean, just workers. So for that country, yes, transfer is a big thing. But usually for average countries, transfer is not important factor. Income is not important factor, but the most important part is the trade. So let me go back. Capital account is analogous to export and imports to import and export. Okay, so capital account and financial flows. Okay, capital account and financial flows are analogous to exports of goods and services because they result in the receipt of funds from other nation. Look at it on the other side also, same. Capital account and financial account outflows are analogous to imports of goods and services because they result in the payment of funds to other countries, other nations. I go back to the first one. Capital and financial inflows, inflows are analogous to exports. Analogous to exports of goods and services because they result in the receipt of funds from other nations. Okay, thank you very much, and we're gonna take a break. This is 12:04, so we're gonna meet at 12:10. All right, thank you very much.
Thank you, Doctor.